Are you looking to improve your finances the right way and beat inflation? Today, we will explore different ways to invest your money regardless of your experience, time, and budget. Towards the end of this episode, you should be able to decide where to invest your money even if you're not a pro. Let's get started. And for that, we're gonna visit our blog here and our NOVARISE page. So one of the best ways to start investing this year is by looking into stocks. And once you invest in stocks, you become a shareholder. So buying company stocks is probably one of the first things that come to mind when talking about investing. Becoming a shareholder basically means turning into a partial owner of that business. Your slice of the pie, meaning the shares, can grow in value, leading to potential profits down the line. Now, I want to take a moment and walk you through the entire share ownership when you invest in stocks, because we have people from different levels, and I want to make sure I level up everyone's knowledge so that way everyone is on the same page. So let's say we have a company right here, right? And this company decides to issue shares. And let's say they divide the company into 8 equal parts. So we got part 1, 2, 3, 4, 5, 6, 7, 8. So let's say there are 8 shares that company XYZ is issuing right here, right? So we got John right here, and John decides to invest in this portion of the company. So now John has 1 share. And then Jane comes in and she says, I want to buy this portion of the company. And she now owns 1 share. So why is it called a share? Well, just once again, take a look at this pie right here. And it's called a share because you're getting a share of the pie, meaning it's share ownership and you're getting a piece of it on your ownership. Same thing with Jane. So she's getting this share right here. And this share would allow you to vote, will allow you to get access to equity in the company. And basically, you are a partial owner. So you're investing in a company, the company becomes yours. The only difference is that you're not operating the company. You are investing money in a company and you have experts or people who work in a particular company doing the day-to-day operations for you. So in this scenario, because John bought 1 share, that makes him 12.5% owner of this company. And same thing for Jane. How did I arrive to this 12.5%? Very easy. I just took 1 and I divided it by 8 because you get 1 share out of the 8 total. And that's how you land at this 12.5. And the beauty of this is that when you invest your money and the company grows over time, that means your money grows. Let's take Tesla as an example. Their single share cost less than $30 just 3 years ago. And today, at the time of this episode recording in November 2023, Tesla stock is currently trading at $222. Just imagine the amount of money that you can amass over time. You see, when it comes to stock investing, you have to make sure that the company has been around for a certain amount of time and that this company is providing a certain product or services that people are currently using and that there's demand for it. So Tesla, we associate Tesla with the car. And in addition to that, we know about government incentives to incentivize the consumer to transition from gas car into electric vehicles. At least that's the rule I typically follow to invest in the stock market. Now, moving along, the next type of investment we have is bonds. And bonds is basically earning money through debt investments. So when you're investing in bonds, you're essentially lending out your cash to entities like government, businesses, and corporations. And when you buy a bond, you are buying a piece of their debt, and in exchange, they agree to pay you back with interest over time. And bonds actually take priority in the event of a bankruptcy. That means that if a company goes bankrupt, bondholder, in this case you, will get paid first and shareholders get paid after. Now, I want to transition back into the tablet and I want to talk about stocks versus bonds, because this is something that I didn't really quite understand at the beginning, right? Why would someone choose to issue stocks or issue bonds, or why would someone will prefer to buy stocks versus bonds? So let's just put it this way. Stocks, they're equity. That means that when you buy a stock, you own a piece of the company within yourself. When it comes to bonds, that means that you're actually lending money to them. So you become a creditor, so to speak, right? So you're lending money to the company, and in exchange, the company will eventually repay you the money plus interest in the future. All right? So we're good so far. So this is how you view things if you were the investor, meaning that if you're looking for a company to invest and you're undecided between going with stocks or bonds, this is how you would look at it. As an investor, if you invest in the stock, that means you become an owner of a company, a partial owner in this case, because you're buying a limited amount of shares. And if you decide to invest in bonds as an investor, that means you become the creditor, you lend the money out to that company, you both come to a mutual agreement as to the rate and how long you will get your money back, and you become the creditor. Now, let's assume we want to reverse the roles and you're no longer the investor. This time you are the business owner. So biz owner, okay? So as a business owner, things work a little bit different. Let's say you have a company and you want to expand it, but you don't have any more capital left. And you're considering either one of these two choices. You can either issue stocks, right? So you want to issue stocks, or if you want to issue bonds. So what's the difference between the two? When you're issuing stocks, you're giving up equity. That means whenever you need to make a decision, you need to do it through votings. That's why every time there's a major decision in a company, you will see letters to shareholder, or you will receive an invitation to vote on a major decision as a shareholder when you invest in a company. So as a business owner, if the roles were to reverse, it's kind of like the same thing. So you will not be able to make a decision on your own for the company because you're being publicly traded in the stock market. That means other people have invested money in your company, and whenever there's money involved, that means they also get to call the shots for you. That's why a lot of people prefer to do bonds in this case, because in essence, you're not really giving up your power. Instead, what you're doing, you're taking out a loan and you issue a IOU. And then through the IOU, you are in essence saying, hey, I need you to lend me $1,000. And within 5 years, I will repay you that $1,000 plus interest. And so whenever you're dealing with bonds, you are in essence just borrowing money from your creditors. That's why the block said that whenever a company goes bankrupt, whoever is the creditor, meaning whoever lends you the money, gets to collect the money first. So if you invest in bonds and the company goes bankrupt, you will get to collect the money first as a bondholder, and shareholders get to collect the money last. That's just simply the way it works. Debt gets paid first, and whatever's left of it, that will go straight to the shareholders, anyone who owns the equity. And if you think about it, it's kind of the same when you own a company. You make money by selling a product or service. You have to pay all of your expenses, including your debt, and whatever is left, that's your profit. That's whatever will go out to you. And a similar analogy gets applied in the event of a bankruptcy. Now, I know that whatever you're seeing here in this tablet is just a simplified version of it. Big companies, especially the ones that are publicly traded in the stock market, or companies that get to a point where they get to issue bonds, are a lot more complex than this example that I just gave you. But hopefully you get the gist of it through this illustration. Now, let's get back to our blog. Another way to invest your money this year is through index fund, and that will allow you to diversify your portfolio even more. You can actually invest in stocks and bonds and in index funds, or if neither bonds or stocks suits you, or you just simply want to diversify your portfolio, you can invest in funds. So an index fund like the S&P 500 pulls together a bunch of stocks, and when you invest in a fund, you don't get the shares of a single company, but rather a small portion of each of the businesses that make up the fund. If some of those stocks lose value, the others could balance everything out. This is a good idea for beginner investors, allowing them to know the process better and to overcome fear. Besides, Charlie Munger, who was the vice chairman of Berkshire Hathaway, believed index funds are safer than investing in just one company. Now, I know I said a mouthful, and because of that, I want to go ahead and give you another illustration to help you simplify what I just read. So let's say this is the fund, and we're going to call this the index fund for the S&P 500, right? So the way it works is that a fund is created, and then investors can come in and invest in it. So let's say John comes in and invests money, then Jane comes in and invests money. So that fund will pull everyone's money together, and they're going to go out and buy individual stocks, and those stocks are going to be owned by this particular fund right here. So in this case, we're talking about an index fund of the S&P 500. So what does that mean? That means that this fund will go out there and will buy stocks, right? And there will particularly pick stocks that belong to the S&P 500. So for example, Tesla is one of them. Microsoft is another one of them. Exxon. We also have Visa. So what this fund does is that it will purchase each and one of these stocks that belong to the S&P 500, and all of it is going to be owned by that index fund. And so when John and Jane come in, or even when you come in and you invest in the index fund, you are owning a piece of each of these stocks that I just mentioned to you. And the analogy is that because you're buying all of these stocks, everything will even out. So let's say, for example, if Visa were to go down in value, but Tesla is actually going up in value, that will sort of like help you even things out, and in the long run, hopefully not lose money, but actually go up in value with your investments. That's the beauty of investing in this type of funds, that you get to own a little bit of everything with your money rather than having to, amass a large sum of money just to be able to go out and buy each individual stock. You actually get to own all of them all together within one fund. And aside from that, another benefit of investing in index funds is that usually these funds are managed by professionals, which means they have already done the research, they have experience in managing it, and you can, in a way, sit back and relax because there are professionals actively managing it for you. And lastly, another benefit of buying an index fund is diversification. You're not relying solely, in this case, let's say Visa, but you're actually owning a little bit of everything. You have Tesla, Microsoft, Exxon, Visa, and so that way you're diversifying your risk across multiple different industries. Another way to invest your money is by investing in trust, and you can actually do that by investing in REITs. So for those who don't know, REIT stands for Real Estate Investment Trust. And the way REITs work is that they let you invest in real estate without you having to buy properties yourself. And because REITs are actually traded in the stock market, you can actually buy or sell your shares anytime, providing you the flexibility of quick access to your money, which is known as liquidity. And while real estate doesn't have the highest liquidity, REITs are much better from that perspective. And if you're looking for a way to invest in REITs, I personally like to use Fundraise, and they offer great options when it comes to investing in REITs. And if you want to know more about Fundraise, there's an episode right here that you can actually check out after you're done with this, and you can find the description to that episode down on the description box below. Now, once again, I want to take a moment to kind of like illustrate how REITs work, just so you can have a better picture of what goes behind the scene. So there are different types of REITs, but for the simplicity of this illustration, I'm just gonna pick just an equity REIT. So you have a REIT, right? So you have a fund here, and basically, once again, John comes in and invests money. Jane comes in and also invests her money, and you also have the option to come in and invest your money. And so this REITs right here, this trust, is actually pulling capital from everybody who wants to invest in it, right? And they get that money through the stock market. And once they get all that money, what they do is that they go out and they buy real estate. And this real estate is owned by them, it's operated by them, it's managed by them, and whatever profit that they make is actually paid out to the shareholders through dividends. And who are the shareholders? That's you. This type of investment is perfect for those investors who want to get into real estate but don't necessarily have the time, the patience, or the energy to go out and do market studies, search for properties, deal with a mortgage, deal with the property management of that property. So you don't have to deal with any of that. All you got to do is just to put your money in a REITs, and the professionals are going to take all that capital. They're going to go out, find the real estate, and they're going to turn it into income producing properties, and you get to collect that profit through dividends. Now, back to the article. Another way to invest is by investing in real estate. And real estate investing is such a big topic, and it's kind of hard to summarize it in one single paragraph. That's why we have hundreds of videos on that, and that's why you're following our channel. Still, real estate is one of the most ancient investments, and the secret to its popularity is tangibility, meaning you can touch it, usability, because everyone needs a home to live in, and value appreciation over time. One crucial rule that you should remember, though, is that your house can be an investment only if it generates income. And if you happen to be in the market looking for income-producing properties and you don't know how to get started and you don't know how to run the numbers, I want to take this moment to invite you to sign up to this webinar. And the webinar comes to you at no cost. And that webinar, you're going to learn not just to deal with the finances and how to finance a property, but you're also going to learn how to find income producing properties. That's very important because not every single property is worthy of investment. So you're going to learn all of that, and all you got to do is to sign up for it. Find the link down in the description below, and the webinar is free. It comes at no cost to you, and all you got to do is sign up. Do not leave for tomorrow what you can be doing today, and let's start the year strong. See you at the webinar. Take care. Bye-bye.